All right, back to markets today. As you know, a severe sell-off underway here. And our next guest says despite the rallying of recent weeks and months, really the last year in the stock market, stabilization of housing prices and economic improvement there, still need for caution. Here to tell us why is Dean Curnutt, president of Macro Risk Advisors. Now, before forming Macro Risk Advisors, Dean spent a decade structuring equity derivatives and swap trades at Lehman Brothers before moving on to head equity sales trading at Bank of America, which ranked first in overall listed option market share. In 2007, he was named the 2005 U.S. Equity Derivatives House of the Year by Derivatives Week. So, Dean, great to have you. So, you're on the record. You've been wary here about the stock market rally for a while now. So we're seeing this major sell-off today. So are the risks you've been worried about finally coming to the forefront for a lot of investors? Unfortunately, they are. On our radar screen has been the sovereign risk, and we think despite the government's best intentions in the U.S. By flooding the market with tremendous monetary stimulus, the sovereign risk is real. We're seeing it play out today, and obviously in Europe, in Greece, and Portugal, and Italy, and Spain. And you know, one of our concerns is that the transmission mechanism is truly and almost always through the banks, and we're seeing a huge sell-off, not just in the equities in these countries, but specifically in the banking equities, and that's a worry. And you say this could ripple effect into the U.S. considering our mounting debt, which really hasn't gotten so much focus in recent weeks. We're so zeroed in onto Europe, but really we have to pay attention here from our perspective. Yeah, the debt problem's global. There's no doubt about it. I mean, here and now, of course, is Greece, which has got a refunding that's coming up in weeks. Portugal's got a small refunding in weeks, but the market's testing, you know, these weaker peripherals in Europe. But if you look even at the bigger countries and more powerful countries like the U.S. and the U.K., these debt burdens are substantial as well. Manufacturing, sorry, Mark.
No, that's okay. Go ahead. Go ahead.
I was going to ask about this manufacturing read in China, which we're also pointing to here. Bloomberg is another spark for the sell-off today. Is that a real concern about global recovery?
The global recovery seems like it's actually in place. So I think you've got this really interesting push and pull right now, positive and negative forces. You've got the debt problem that we just discussed. We've got very high unemployment. Housing is an issue. But this global manufacturing-led recovery seems like it's in place. So I'm not sure what to make of one data point through China. I will say that China is in the process, as is India, of embarking on a tightening process. And that's, you know, long-term not good for risk assets.
Okay, speaking of risk assets, Dean, what do you think when you see what's going on in the markets today? We're seeing that sell-off that we've been telling you about. Dow Industrial's now down about 237 points.
Markets reacting to you know, the issues in the sovereigns in Europe. We think those are big deals, and we thought the market was, you know, not necessarily really keeping up with this in the last couple of months. We saw the VIX go to 15.
Yeah.
And you know, the fact of the matter is the VIX can coexist. The low VIX can coexist with high degrees of systemic risk.
So why are investors focusing in on that today? Like, why is it all of a sudden coming to the forefront? You know, the VIX is shooting up to a level of almost 20, as you just said.
You know, I think we have to ask ourselves the same question. For example, in late 06, early 07, the VIX hit 9.9, even as the housing bubble was clearly starting to burst. There's some trigger that ultimately people start to give into. Now, maybe this is, you know, maybe this blows away, but you know, we think it's relatively risky right now.
Now that the biggest part of monetary and fiscal stimulus, now that that's behind us, I guess the next move is in the Fed's court. What's going on there?
The Fed has proven to be on the side of the market for quite a long time. And you know, this low for long strategy that investors have been counting on with regard to the Fed, keeping the monetary stimulus in place, has certainly been a justification for keeping, you know, this bid to risk assets. We're worried that the Fed might be behind the curve. I mean, they've proven to be very patient in terms of monetary policy, but it's clear that the lion's share of the stimulus coming from the Fed is behind us.
All right, so Dean, you're an options guy. Sharp and volatile turn for today's trading. How would you, I guess my question is, how would you recommend using options to protect yourself in this climate?
Sure. Well, one of the adages we follow very closely is hedge when you can, not when you have to. If you look at late 08, you saw the VIX go.
Is it like too late today to start hedging?
No, absolutely not. Absolutely not. We don't think the longer dated options can in any way embed the kinds of uncertainty that we see playing out over the next year.
Why not?
Because right now, again, the market, the shorter dated volatility, i.e. the VIX, is being weighed down by the fact that the government is forcing people to take risk via 0% interest rates. If you have no choice, you know, you make zero by keeping your money in the bank, or you make something, you know, you're being forced to take risk. But the big question for risky assets is if we start to see rates go up globally, then the opportunity cost of not doing something becomes higher, or lower, I should say, and that's not good for assets like stocks.
All right, Dean, appreciate your time and your insights today. Dean Curnutt, president of Macro Risk Advisors.